You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor series, where each week we give you a raw and honest account of what it's like to be a rules-based investor, what news and articles caught our attention, and of course, where we do our best to answer your questions. This week, it's just Jerry and me. Moritz is out. So let me start by saying good morning to you, Jerry. How are you doing this Sunday morning?
Great. Good morning. Good afternoon. How are you?
Very well. Still in sunny Denmark. So enjoying a bit of cooler weather compared to Switzerland, at least, and other parts of Europe. So that's very nice.
I'm in sunny Amagansett, New York, enjoying the beach.
Very nice. Very nice. I was going to start out just again by acknowledging some of those of you who took time out of your week to leave us a nice rating and review. We want you to know that we actually read all of these reviews and they help us stay on course to provide as much value as possible. So specifically, I was just heading into the US iTunes store and I saw people like GPC31. There was another handle called US Weeping and RCK7000. And in addition to the three I just mentioned that I could see, of course, I also know that a lot of you leave comments and reviews in your local iTunes store. So we appreciate that. And actually, for those of you who may not have had time to do it just now, if you want to do it easily, just head over to toptradersunplugged.com/review. There's a little directions about how to do it, and it shouldn't take you more than a couple of minutes. I want to jump back to the markets, of course, the market action for the week. We had another week where U.S. stocks, had a positive week, now sitting at 21% year-to-date gains. So the bulls are firmly in control. For bond and energy traders, I think it was a pretty uneventful week. Very little movement on either side. Soft and grains were mixed, while the VIX closed down at levels we haven't seen since April. Of course, all of that in anticipation of the very predictable outcome, I think, of the coming week's U.S. rate decision. It all sounds pretty, good, like everything is very rosy, but maybe not so much if you saw the comments that came out this week from the ECB chief, Mario Draghi, who still has a couple of months left on the watch. He was quoted saying, "It's difficult to be too gloomy today, while the outlook is getting worse and worse," and indicated that rate cuts and the resumption of asset purchases are in the cards, I should say, for September. And of course, we talked about this before. We now have about $13.74 trillion of bonds with negative yields around the globe. So I want to continue maybe a little bit longer today than I normally do about things that could even sound a bit fundamental type analysis, which is not what I'm trying to do here. But I want to put people maybe in, give a little bit of impression of what is out there from some of the people that are worth paying attention to. I was listening to a great podcast from Macro Voices, where Eric had Peter Warburton addressing a couple of topics similar to what I just were quoting. And he said something along the lines, "A few investors today will remember the unhappy experience of bondholders during World Wars I and II. When you look closer, the similarity of central bank balance sheets expansion in recent years with that during World War II, it is pertinent to inquire whether this is World War III for bondholders. Interest rate suppression and yield curve control artificially lowers the cost of debt service for household, non-financial companies, and of course, governments. However, rate normalization, which can be policy-led or credit market-led, implies rising debt service ratio and painful debt dynamics for those who have grown very comfortable with bargain basement borrowing cost. Moreover, rising private sector debt services ratios expect downward pressure on tax yields, depriving households of disposable income from which consumption and indirect tax revenues derive. The twofold fiscal stress of the rising public sector debt services burden and the diminished scope for tax collection creates the potential for an explosion in the budget deficits. He then goes on to talk a little bit about financial repression, which he thinks is, usually played out in two acts, where Act 1 is where interest rate suppression, but this is not, and I'm quoting here, and this is not and can never remain a settled state. The so-called new normal is nothing of the sort. Rather, it describes an interim state of disequilibrium. When Act 1 ends, perhaps there is an intermission, enough time for a quick gin and tonic and a trip to the facilities, but very soon Act 2 begins. Act 2 is unanticipated inflation. Unanticipated inflation, by definition, is an unpriced risk. Act 2 is coming. So this was just something I picked up during the week from another podcast. I thought that was interesting, but it also is interesting for me because we mentioned last week that there was, Ray Dalio has been out with one of his sort of thought-provoking updates, and he's also expecting this new, 10-year or decade of regime change coming in the not too distant future. I'm not going to read from his article; it's well publicized, but again, another one expecting something large to happen in the market in the next couple of years. And so for me, all of this just screams to investors that how important it is to really be truly diversified, I should say, with strategies that are uncorrelated. It also suggests to me maybe that we'll see more trends, we'll see more divergence, two things that we as trend followers like, and perhaps we'll see that this will come back with a bit of a vengeance in the not too distant future because of, slightly fewer of those in the last few years. Anyway, Jerry, that was a really long introduction. Normally Moritz is here to give us a rundown of this week in trend following land, but since he's not, I will jump in and basically on our side this week, I would say we did manage to squeeze out a small positive performance, pretty much matching, incidentally, the S&P's year-to-date returns. And this week it was really led by Australian fixed income. Currencies did well, coffee, and a few of the equity markets were fine. And there was a few challenges as well, of course, in the week. Things like cocoa, cotton, short-term fixed income markets were a bit challenged, and also a couple of the Asian equity markets. But overall, a positive week. Not much change in exposure themes or anything like that. Pretty stable, has been for a while. Obviously with a trend following performance, which for the year and for the industry has actually been pretty stable, quite solid. We don't tend to see big changes in the portfolio, except for those markets, of course, where we've seen some major reversals during the first 7 months of the year, as we've talked about before. But anyways, how was your week? How was trend following stateside?
Well, pretty much like yours. Seems to me that the big news is still stocks and bonds, and every rally, every sell-off should be bought, and that's been rewarded. So commodities like corn and our recent spikes, corn and gold and nickel, kind of we're still waiting to keep going. They're just sort of sold off a little. Bitcoin, my fave, is sold off more. So hoping that those are going to come back. dollar. The dollar, I think, it might have made getting close to new highs in the futures or the cash. I think one of the two it made new highs. But interesting that because that index is dominated by the euro or more European currencies, the opposite is occurring in Mexico. The Mexican peso, it's near the highs. Israel, India, rupee near the highs. Turkey near the highs. Brazil, South America, South Africa. So I'm long a bunch and short a bunch. So defying, not caring at all what the index says. But it's been a good period recently. We haven't done a lot of trades, and I don't have a lot of stress. So I'm waiting for the shoe to drop, unfortunately.
Yeah, we shouldn't jinx it, but it has been a less stressful period of time. Actually, unusually long, I should say, but I really don't want to jinx that side of things. So let's hope that the trends are here to stay for a little while longer. And even if there aren't, and I think sometimes it's a good thing to just, prepare people for the inevitable, and that is that we'll have monthly losses again, and we will have corrections and all of that. But we are still, in my opinion, in a recovery because as an industry, we haven't really reached new highs. We still got a little way on our side back to the latest high. But so far, things look like any other of the many drawdowns we've had in the last 45 years on our side. So that's good. Exciting update, I hope, on the live event. We're slowly filling up the live event, but we still have a few spots left. As you may remember, we decided to do, so far, just a one-off live event, Moritz, Jerry, and I meeting up with a group of, say, 10 to 12 people max in New York, October 26th to October 27th. And really to create some major breakthroughs for those of you who are into trend following or are into building a business around trend following. So we want to help you do that. Now, the exciting part is that we actually managed to put some of these details on the website. So if you go to toptradersunplugged.com/live, you'll see a few more details. And for those of you who are quick enough to grab the last few spaces, we very much look forward to seeing you in a few months. Why don't we jump into our usual segment, Jerry's Top Tweets, as we so lovingly call that part of our conversation.
Pressure's on.
What have you? Yeah, what have you got for us in your mailbag, so to speak?
A lot of good stuff. At least I liked it. Not a lot of retweets or a lot of likes on some of these, but who cares, right?
Exactly.
We're in it for ourselves here. Let's just start with always our most favorite Wayne tweet. He had a lot of good ones this week. A lot of people love this guy, and he's just really good at bringing complex things down to my level so I can understand and get comfort and keep going with a systematic strategy. But he talks about drawdown, commenting on someone else's tweet about how drawdowns are tough. He goes, I feel like the depth of the drawdown is just the beginning of drawdown risk. The real killer is the time to recovery and consequent unknown area underwater. While we can at least look at various past depths of similar magnitude, every one of them has a unique area and time. Modeling gives us nothing. Wow, because we're looking at that backtest a lot, CTAs, and we're saying, I see that worst drawdown. Moritz and I have said, well, what we see with our strategy might, unfortunately, close your ears here, be twice the return. So if our average return historically on the back test is 10, we're going to expect at least a 20% drawdown. So 1 to 2, that doesn't sound great. And but Wayne is saying that modeling gives us nothing, and we can't really rely upon that, which I totally agree with. unfortunately. But that's why I'm pretty constantly saying I try not to look at much of the past as a guide to the future, other than I will submit to the idea that, okay, if the average trade over 30 years worth of data, lots of markets, lots of economic cycles is X, hopefully my average trade will be something similar in the future. But the equity curve is probably going to be a lot different. The profits are going to come from different places. We may never make money in bonds again, as long as I'm alive. So what? Hopefully we can pick it up in other areas.
Well, I mean, you mentioned this thing about having expected drawdowns twice the size of the average return, and of course, when people hear that, they might think, "Ooh, that doesn't sound great." But let's take a step back and just remind people that, well, the expected drawdown long term of the S&P is 8-9%, yet it has shown us that it can have drawdowns of 5 times or more. So our ratio is not so bad, even though it can be difficult. But you think you bring up a very important, or Wayne brings up a very important point, and that is, what is worse, having a deep drawdown or a long drawdown? And I mean, none of it is pleasant. But I actually think from a business point of view, sometimes having a long drawdown can be more detrimental to your business, because it challenges the patience of investors more so to some degree. A deep drawdown certainly challenges the fear of investors, but patience is not to be underestimated. And so one of the things that I think is interesting when it comes to trend following and trend following systems, and something I've come across in my conversations with potential investors, where for example, we might get compared to someone who's also in a drawdown, and where they say, but let's just wait until everyone comes out of this drawdown, as if it was by de facto that we're all going to come out of the drawdown at the same time. And so I actually think that of course the way into a drawdown is important, but the way out of a drawdown, how quick we can recover, how good our systems are to get out of a drawdown, I think is really important, and something that I think a lot of people may not pay as much attention to. They're more worried about the way down than they are of the way up, and I think we need to be worried about the way up as well, because if you get into a drawdown, it takes you 6 months, but it takes you 3 years to get out of it. I think that is equally a problem. So I don't know if it's something you've ever thought about, Jerry, when you look at your research and stuff like that. But I actually think you should also analyze how good managers are to recover, not just how good they are to maybe avoid the worst drawdowns.
Yeah, I don't know. I look at it differently. I'm trying to have a good average profit, capture the big winners, have a good win percentage in the low mid 40s. So I'm really looking at those stats, and I just don't know how, and I've got to follow my system. So if I've got to follow it, how can I manufacture? How can I improve my drawdown and my recovery? I think it's out of my hands. I really just am helpless and passive. And let's say when I come out and I finished number 1, I had the worst drawdown of everyone. I was in a drawdown for longer than everyone. And then I come out and I'm the best performer over 3, 5, and 10 years. Okay. And I lost a lot of clients. So if that's possible, which I think it is for you, for me, for Moritz, for all of us, that scenario, possibly part of the reason I came out and I was the best performer is because I had nothing and I did nothing outside of the system. And the system did not contain anything that would help me reduce the drawdown, other than leverage and my trade stats that I've already mentioned, or something that was going to help me reduce the time of the drawdown. I just think that we're helpless. And if we're going to trade the system, how can we manufacture something better than the system trade stats? And once again, over previous episodes of the podcast, we talked about this study that said that the top performers underperform longer than everyone else. So Buffett has definitely underperformed for long periods of time. And a lot of managers have, the ones that underperform the longest have the best performance. So it's almost like we don't want to do anything. Following that system creates the biggest drawdowns and the longest drawdowns, and also the best profits. It's a conundrum. I can't figure it out.
No, and I agree. I mean, it is a conundrum, and I'm not suggesting that you can manufacture just one part of your system, meaning you can just say, okay, I don't like the length of this drawdown, so so I'm just going to change the length of the drawdown. I don't think you can do that. But you, on the other hand, you say that you look at your stats. Well, surely, but that and that's exactly right. I mean, you would have to change something in the system, therefore your stats would change. But if you're still happy with them and they give you maybe a slightly different recovery profile, maybe that is better than not. I don't know. I mean, it's a difficult conversation.
I think Wayne's point is this backtest recovery profile is not something you should expect in the future. So to actively choose a worse system, trade stats wise, slightly worse, a lot worse, that had seemingly a better drawdown and recovery based upon the backtest might be a huge mistake.
Yeah, and I think, generally speaking, I think it's always, challenging and difficult to rely too much on backtest anyway. So I'm of course referring to people like yourself, people like us, where we actually have really long track records to and base it on real recoveries and real drawdowns, nothing that we just pull out of a computer necessarily. But I guess my point was just that I think that from a business perspective, and we all run businesses as well, we need to also be aware of, at least, that recoveries, the wrong ones, so to speak, the really long and painful recoveries, can actually have a detrimental effect on our businesses, as well as how we manage the way down into the drawdown. But Wayne always seems to come up with these, thought-provoking ideas. So I think it's worth talking about, being aware of.
Well, another interesting topic, we can spend a couple seconds on this, was this idea about an article that was recommending commodities. And if you believe in a reversion to the mean, and when looking at things from a value standpoint, commodities look pretty attractive. And of course, we trade commodities long and short all the time. We love commodities. They're the best. I'd just like to see a few of them start going up, or lots more of them going up. And I just think it's funny in that one way to safely profit from commodities, other than just, and it kind of, it's kind of odd that the whole world just looks at commodities, gold, or whatever, everything basically, is how does it add value historically from a long only perspective? And so we're just like pulling our hair out, like, you got to be kidding me. Momentum works. You've said that, you authors of these articles. So, if you want to add commodities or currencies safely to your portfolio, you've got to do it with trend following, which is a strategy that works when markets don't revert to the mean for a long while. So the fundamental crowd is looking for things to add to the portfolio based upon value and mean reversion. But in order to add commodities safely, you've got to invest in a CTA who doesn't pay attention to mean reversion, except maybe we're all in favor of our average to below average performance, mean reverting to better performance here pretty soon. So buy CTAs and buy commodities, because they're probably going to revert to the mean, I guess. I don't know.
I mean, a lot of articles, of course, in the past, and a lot of analysis had always suggested this thing about, when's the best time to buy CTA is when, as Bill Dunn, our founder, said, always was, the best time to buy a trend or a CTA is at the bottom of a drawdown. The second best time is today. I mean, obviously we don't, and the point is we don't really know when we're going to perform, but clearly if you can buy someone that you believe in long term in a drawdown, that of course have worked really well for many investors. But anyway, back to your point, funnily enough about commodities, and there certainly has been some money made on the short side in recent years, but the article I quoted in the beginning from this guy, Peter Warburton, he actually talks about this, inflation suddenly coming back at a time when none of us can really see any signs of inflation. It may not be now or in the next 2 years, but one of the things he talks about in this interview is that it could very, very easily come from a sudden increase in commodity prices, even though it's something we may not think is possible right now, given the suppressed levels we've seen in many commodities in recent years. So it's all about the unexpected. But I agree with you, and it's always it has puzzled me a little bit that we as an industry certainly started out having lots of commodities in our portfolios. And it's a great source of true diversification because we know financials have become more and more correlated. So if we want to maintain the role of being uncorrelated to the traditional assets in people's portfolios that we're trying to diversify away from, I think it's important we maintain a large exposure to commodities. It is still, in our view, when we look at the research, it is still the least correlated part of the portfolio. So we love all these commodities, as you said. Yet I do still come across people who say, yeah, but commodities are more risky than financials. But as you've mentioned many times, people should never forget that we size our positions based on the risk and the volatility in those markets. So they should never become more risky as part of the portfolio than any other market. So yeah, but I think it's an interesting discussion, and I agree with you. I mean, funnily enough, talking about the press, and you talked about these articles that always take the long only side when they do the analysis. We haven't heard much from some of these Bloomberg's reporters that basically wrote about the death of trend following back in February. They haven't really been out in force lately. So maybe that's a good sign that they have seen. Maybe they are actually starting to regret that they wrote all these articles back then about trend following never working anymore.
They have to write something, so it's probably a contrary indicator as well. So we may need a couple more really big trend following, hating on trend following articles, and then that will signal a new day, a new dawn, and people understanding the importance of including all these markets. It's the only way to get It's the only way to get maximum diversification in your portfolio is to use trend following with small losses, going with the trend in shorts. A lot of the articles that I've been reading this week they're sort of similar, but I'm always in favor of just continuing to beat a dead horse. If you know what that expression means, just keep talking about the same things. But one article this week stated that we've heard this before. Most stocks around the world do not beat the risk-free rate. It's just a small percentage of stocks that make all the money. In the long run, stock picking is a loser's game. Once again, from a long-only buy and hold point of view, and I write, and yet using trend following on stocks turns this on its head. Almost all stocks will beat the risk-free rate by a lot. Trend following converts buy and hold returns into a different set of returns. It's not really correlated to the buy and hold set of returns because of the way we size and then go long and then get out, or we go short. And so all of these markets are converted from maybe not being that great long only into all of them being great. Even all the stocks make about the same amount of money, over a long back test. And as we've mentioned, our friend Eric did a back test of all the stocks that had gone out of existence through bankruptcy or being bought out, the missing stocks. And they made about the same amount of money using trend following as the stocks that still exist. So that's just something that we can never get away from, that you will not get diversification and performance and all this diversification you get with a CTA type portfolio or a stock only portfolio. There's no sacrifice of return. In fact, with the stocks, we've already said they'll all make good money. Almost all of them will make money using trend following, whereas 95% of them don't on a buy and hold.
So I don't know if you've done this. I don't know if you remember, if even if you did, whether you remember any of the details. But compared to a long only portfolio of stocks, this is something that's outside my level of competence. So because I never looked at it. So, but maybe you do. If we, as we mentioned before, long-term returns for equities in the US have been, about 9% or so, but also with some big losses along the way. If you did trend following only on stocks, but diversified and all of that, long and short, stuff like that, I mean, how much have you been able to quantify what the expected improvement should be? Is it just the improvement on the downside you get, so you kind of maintain the annual average return but with a lot less risk, or where do you see the improvement when you mention that? And of course we will caveat with all of the usual risk disclosures that past performance isn't any indicative of any future results, but just out of curiosity, what would you expect from a well built equity only trend following system? Because we hear a lot about how it's better, but how much better is it really, do you think?
I think that's a good question, and I don't have those numbers in front of me, but I have seen those numbers, and I don't think that I think number one I would say is that if we had to trend follow stocks only, we would have dismal performance. The 8 or 9% with a 50 plus drawdown, we'd have 30% drawdown or something like that. But it would, we definitely don't want to be put in that situation to only trade equities, even with our fantastic trend following, which we love so dearly. So that's a given. But what happens is, try to sum this up from what I've seen, is that it depends on when you ask. Like if you ask me prior to 2008, trend following stocks, probably the index of the S&P or trading the 500 stocks individually, it probably underperformed for many, many years, because we kept getting out, and it was never a time to get out. It just went up, and up. So trend following is scaling back and then having to take small losses and then getting back in at the highs, and the index is just blindly going up. But then after 2008, not only was the drawdown a lot less, but stocks were negative for 10 years. So now would be a bad time for us to say, hey, use trend following for stocks, because what's happened with the index since 2008, it's gone straight up. And the trend follower, inevitably, all 500 stocks were in the index quite a few times, was flat, flat or reducing the positions, and only to see the market make new highs. So if we have this huge bear market, once again, the trend following of the stocks or the index will have better performance. So it's just kind of, you have to wait. You have to wait until you see the bad side of just holding on to a passive index.
But if I understand you correctly, Jerry, what you're saying is, gun to your head, if you could only choose one, you would still choose fully diversified, including all the commodities, the currencies, et cetera, et cetera. You wouldn't do just stocks only as a trend follower. Is that correctly understood?
Oh, of course. I mean, I look at my portfolio every day: corn and wheat and Swiss franc and gold and silver and nickel, Bitcoin, cattle and hogs. I just love everything I see on that portfolio, and I could never imagine not being able to be in those markets. I see them as trends that are up, trends that are down, offer me so much more risk control, and the ultimate risk control. I don't have to do anything. Just get my leverage correct, get in gear with the trend, and I'm going to be so much safer and not sacrificing any return. The S&P does not trend better than cattle. This is a shock, but this is the question. What am I going to lose? It seems that stocks just have bigger trends. They just make more money. Well, yes, recently, that's for sure. But I don't think that that's a good thing to anticipate in the future. The currencies are just as good as the stocks. And maybe stocks are slightly better than the metals. I doubt it. But something's going to be in first place. But also, any of these markets and sectors can be dreadfully in last place, as we've seen, But there's nothing as good as it's just being able to look at that portfolio on a daily basis and see all that diversification. I know people are saying, why don't you get a hobby and enjoy life more? Maybe I should, but I really enjoy on a daily basis being in all these different markets.
I thought trend following was your hobby, actually. So, but there we go.
Another one, I guess.
No, but it's true. I mean, our finding is exactly what you've said as well. We find that in our research that all markets has the same ability to trend and has the same ability to produce the same returns. But we're talking about over 2, 3, 4 decades, not in a 10-year period like we've seen now, where clearly some markets have done better. But that's one thing. But I think it brings up something we've mentioned previously on the podcast, and that is, this is where I find sometimes that investors are being given a little bit of a bad deal when they read some of these books about trend following, because it kind of suggests that you can just take it and apply it to, say, stocks only, which people are mostly familiar with, I understand, and then it's all great. But frankly, it may not be all great if you just apply it to a narrow set of markets, and frankly, not that many people can trade 500 stocks at any one time in a trend following portfolio. So they end up either choosing a few stocks or they choose a few indices, and the results can be very different from what Jerry and I think are referring to here. So, which brings me back to this point about that sometimes it's not necessarily the best idea to try and do it yourself. I mean, as much as we love everyone who loves rule-based investing and trend following, sometimes we also have to be realistic and say, well, if you can't get the diversification trading all the markets that we trade, you may be better off spend your time finding a manager that you can work with. And maybe if you're just still interested, do a little bit for your own account. But it is so important to get that part of the equation right, meaning the diversification, and that just requires a bigger account size nowadays. So,
continuing on our stock rant here.
Yeah,
I'm taking liberties here, but
Morris is not here to stop us. We can do whatever we want today.
He doesn't. He never tries to stop me. So I wish, for my benefit, he probably should. But so, anyways, I was responding to a tweet about Crisis Alpha. Ooh, I don't like Crisis Alpha. So I think my point in this was that Crisis Alpha. Oh, yeah. So let's do the back test. And what do we want to achieve on this back test? We want to achieve the perfect portfolio. So it's got to contain all the markets, long and short. Longer term trading look backs than historically, but that's okay. We can manage through. We want to be profitable. We want to make a good return, and at that drawdown, hopefully stop it at twice the average return or something. So we're really going to, that's our goal with our back test, is to come up with multiple entries and exits, multiple systematic approaches, different parameters. And so we've talked all about that. So I just think, then are we going to say, well, how's it going to do with Crisis Alpha? And it seems to be a more perfect portfolio type of a system than a strategy, rather than a perfect hedge type of a strategy. So I think by definition, the way I've defined this is that it's going to be suboptimal if we then say, now let's twist it around to where it's better Crisis Alpha wise. Because if we chose the right time frame and the right markets, it's not probably going to be that great when the stock market has these 1 day to 2 month sell-offs. 2008, yes, it's going to be fantastic, but the sell-offs since 2008 have been short-lived, and then that's now been turned into Crisis Alpha. and where were you CTAs for that month or this month? Well, we were focused on more creating a better portfolio than being your buffer, for a temporary sell-off. Then I go on to say, real crisis alpha is having a trend follower trade your stocks for you. Give me your stocks, or put it in my portfolio where there is a fair amount of stocks that I can trend follow. Versus trying to allocate 5 or 10% to CTAs and expecting them to have a meaningful impact on your dysfunctional portfolio, because you're long bonds, you're long stocks, and then a 5 to 10% allocation to alts is dysfunctional.
Yeah, I mean, you bring up a good point, and it is a big discussion, right? Because we now live in a time where I think a lot of investors are looking for the ultimate investment, right? Something that ticks all the boxes, and one of those boxes is, of course, as you say, quote unquote crisis alpha. Can you make money every time there's something going on negatively in the equity space? And of course, as trend followers, we know we can't, especially after a massive run up in equities, because we will be, by definition, long equities. So we will be highly correlated at that stage, most likely at least. So that is a challenge. I think that's a big challenge. And as much as I love the person who coined the phrase crisis alpha, I actually think the term in itself is causing a problem for us, because one, we should not be known for that, because we can't actually even deliver on that. And I think a lot of people are now incorrectly suggesting that we should deliver on it. I don't think we can as true trend followers. And secondly, we are an uncorrelated return stream by definition. And therefore, there will be times where we are highly correlated to equities. There will be times where we are negatively correlated. There will be times where we are not really correlated one way or the other. And so this discussion about being a hedge or being an uncorrelated or diversifier is very important, but it's being taken in one direction. And those who really want or are considering us as a diversifier, they are, maybe unrealistically expecting us also to deliver every time there's a small, 2-week, 4-week, quote unquote, correction. Because I don't think we really had a crisis for quite a while. I mean, we've had corrections, and people expect us to make money during those corrections, which is not possible always to do so. So it's I think it's a big issue for our industry. I think it's being positioned by various people incorrectly, creating false hopes and expectations that we can only fail if you try and position your trend following system like that.
False criticism.
Yeah.
If you're smart enough, and some are demonstrated, that they can trade a strategy that's not anywhere close to the Chesapeake or the Dunn strategy, long-term trend following, and provide this crisis alpha when stocks have a tick down, that you can be positioned to buffet that negative performance, then celebrate. I congratulate you. But don't drag me into this pretend scenario of if all CTAs are not as good as I am and they can't do what I'm doing, they turn their back on their investors, their style drift. Just do your marketing without dragging all of us and having to be critical of all of us. Be thankful that you're an elite trader who can provide this, while the rest of us pedestrian traders are just out there trying to make a living, some of us with fixed fees and no incentive fee. So just in trying to create a better portfolio for people, rather than when you and I first got into the industry, it wasn't crisis alpha. It was the marketing brochures would show the 10 worst drawdowns of the S&P over the past years, and how did CTAs do during those 10 worst drawdowns. And most of the time, we didn't lose as much. Maybe we made money. I mean, look, 75% of the markets, at least, that we trade are not stocks, and we'll go short stocks. So it's no big, huge accomplishment to not lose as much when stocks have their worst performance. But these worst drawdowns in stocks were over months or years, bear markets, and we didn't do as bad. But now this is morphed into crisis alpha. And then how did you do last week or last month? Stocks had this minus 10%. You lost 12. So no good. And so I think that this is the truth of the matter. And my hat's off to people who can have a different kind of business and add value. I'm saying, if you really want me to help you, let me trend follow your stocks. I'll underperform when it's a bull market, but probably help out a lot by having a trailing stop and stop losses when the market tanks.
Yeah, no, I couldn't agree more. I think we just leave it at that. Not much more to add to that one, Jerry. What other topics came up during the week on your side? I mean, of course, I should mention I haven't read it myself, so I don't want to really go into any details, and also fearing that people think we may have changed, or I may have changed to become more fundamental oriented. I will just mention that one person that I do enjoy reading, even though he's not a trend follower, is Howard Marks, and he came out with another memo this week. So I think people should pay attention to his words as well. Which you may think is not relevant for what we do. I think it's highly relevant for what we do, because the world is not a stable place to invest in, and never has been. But maybe in the next few years will, as I said earlier, it'll be even more important to be prepared and not buy the insurance, so to speak, after the event, as we've seen so many times in our industry, like 2008, where suddenly the inflows, because I still see press releases about outflows from CTAs, even 2019, where it's really been a pretty good year so far for many managers. I
wanted to comment earlier. I forgot about
sure.
It said the depth of the drawdown versus the length of the drawdown. And I think historically I've seen it from some of our clients that you were 100% right. If the depth of the drawdown was severe, they weren't that interested in liquidating. I mean, they're kind of like, oh, I can't get out now. I've got to wait till it gets back to the highs. Then I'll get out. And we actually would see that. We'd have a big run up and make new highs, and some would get out. They were sort of like trading us in the same incorrect way that they trade all of their other investments. And then, of course, as you said, just dragging on for a year, being underwater, that would just be a lot more intolerable for some people, that they just couldn't handle it any longer, to continue to have to wait for these for new highs, and they would just get bored to death and just worn out and have to redeem. But
yeah, I've certainly seen more people. I think from just observation, I certainly seem to have noticed that more managers who go through these very long drawdowns have more tendencies to struggle with keeping assets in, compared to those who might have a big drawdown, but actually also have a pretty good recovery as well. So yeah, absolutely agree with that. I think we have a question. We can
let's end with Wayne.
Let's go with Wayne.
Back and forth that Wayne and I had with other people as well. It's kind of interesting. I'll get your take on this. Wayne says, most say that good trading requires discipline. Yes, it does, to avoid impulsive behavior and emotional bias. But at times, it also requires breaking discipline, literally doing the exact opposite to adjust to market nuances. The art is to master when to bend that discipline. And I say, well, for me, good trading requires robust rules. Some of my rules are not as robust, like any that get me out of a trade before the robust ones are elected. So I might have my rules, but then if crazy things start to happen, maybe I won't wait for my exit rule, and I'll have to reduce my positions due to losses or high vol or drawdown. So then Wayne wonders what I'm talking about, and I just basically say, I'm describing how at times I break discipline and do the opposite of my core rules to adjust to market nuances, high volatility, crashes, by definition, these are low sample size events. So even though I have a rule, it's kind of like a rule that doesn't happen very often. And it's not really a robust rule, let's say. So I think that as much as I rail against constant vol targeting and must do things with our systems, the rules must have a high sample size. I do hold out the possibility that we shouldn't be a martyr to these systems, like I said last week, but we should sort of step aside and reduce leverage and say, this could be a time where it's more important to preserve capital and realize that my system might be going through a bad period due to high concentration risk and high correlations or whatever. And I think it's always good to have this outlet to where you can not override your stops, not override your stop losses or the markets or things like that. But once in a year, once every other year, one has to be prepared to say, okay, let's reduce risk by 50%. The whole idea here is to stay alive. And when things settle down, I'll come back in. You know what? And it probably won't work. It will probably cost me a little bit of money. And that's my whole point. I think that's sort of the point he eventually said, oh, yeah, I see what you're saying now. We need to be disciplined. And for us, being disciplined is rule-based because, I'm going to overestimate my discipline if it's just, not based on rules.
That is a tough question, right? I would say that on our side, I can't imagine us not following the rules. I've never come across any indication that, in the 45 years our business has been running, that there's been any sort of discretionary overrides like that. But, that's just us, maybe. Because I understand where you're getting from. I mean, at the end of the day, one of the things that I think trend following at its core are really well known for is to, always be there to trade another day. So making sure that you have not lost so much money that you can't do that. That's clearly, not something you would want to. You don't want to you don't want to risk so much that you essentially go out of business that way either. So if it's something that has never shown up in your test and your live results, and it's really a complete new situation, then maybe you have to do that. I wouldn't disagree, but I don't think we on our side would want to go down that path to override the systems. But that's just based on what's gone on so far. It's not to say that it couldn't happen in the future, of course, but yeah.
I remember when I first started trading, we were using really high leverage, and it's a different strategy and style back then. And an integral part of what we did was equity cutbacks. If you lose money, you got to trade smaller.
Oh yeah, sure.
And I remember a friend of mine said he did a research on this, and he implemented the rules, the equity rules, and he found that you just actually make more money if you just trade it smaller, because the cutbacks were not a good predictor. You were trying to preserve capital, but the fact of the matter is you would just be better off trading half size, and you wouldn't have to use those cutbacks. And of course that's true. And I think the deeper idea here is that the backtest produces a sample size of trades that is collected by every buy and sell. Buy, sell, Swiss franc, buy, sell, crude. And you add up all these buy sells in all these different markets, long and short, over 30 years. That's your sample size. That's your system. Non-system trades, no matter how well-intentioned, are not going to help. They're going to reduce performance. You can call them what you want. You can call them money management, risk control. Yes, it is part of the system. It's not. Trust me. Not saying you don't do them, because the last thing on your mind, if you're over trading or if you're having a bad period, is it going to help me? Who cares if it's going to help me? I am not in a situation right now. I've got myself into a situation where I've had bad performance of the system. I've over leveraged. Whenever I'm losing too much money, I need to do whatever it takes to right myself and get my risk more under control. Correlations are too high, vol is too high. And then it doesn't matter at that point in time whether it's going to help my performance. We're talking survival. So everyone needs to sort of trade small, follow your system, and then get ready. Maybe you'll never have to do it to exercise the ultimate in risk control, which is reduce your positions by 50%, 20%, 70%. I don't know. I'm just saying it has to be in your quiver.
Absolutely. And I also think that that's part of the responsibility when you do your research and you look at your backtest and all of that. And that is not to kind of fall in love with them and think that it can never go worse than this because I've got this backtest that goes back 30 years. I mean, of course it can. And frankly, it's not that long ago that it did. I remember that, and now I forget the exact period, but not long ago, not many years ago, many of our peer group, I think it was back in 2013, actually, now that I think about it. Back in 2013, I think many people in our industry had their worst drawdown ever. Mid-year, I think mid-year was a really tough spot to be in trend following. And so you've seen someone who've been around for 20, 30 years. Of course, many of our peers have had that long track record. And suddenly you see after 20, 30 years, a drawdown that is a lot bigger than what it used to be. And so, so I mean, I think that's the responsibility of what we do is to, when you do your research, don't be tempted to just apply risk that you can own, so you can only withstand a drawdown based on a backtest. You should be able to withstand a drawdown that is bigger than your backtest.
That couple of minutes, I don't think anything is on this podcast is as good as what you just said. That's the big takeaway. If we've done anything to help people, that's it in a nutshell. Just that last minute of what you said is just perfect. I mean, yes, we're systematic, but we need to be humble.
Yeah, absolutely. All right. So before we jump into there's actually only one real question I think today we've got, but I do want to just give a quick shout out to Andrew over at Richmond Quantitative Advisors. He gave us some feedback and a paper that they have done on these. I think we were talking about signal, multiple signals and speed of signals last time we were together. And anyway, they shared some of their insights on this. I think they agreed with our finding and what we talked about last week with Moritz, and they gave that to Moritz, which he shared with you and me, Jerry. So shout out to you guys and to everyone else, of course, who shares some interesting stuff that we can then help other people with. Now, we have a question from James. James, I think in the UK, if I'm not mistaken, that's where James is. Just to boost our egos, let me start by reading what James actually is saying. He says, I'm thoroughly enjoying the content on the podcast. The bottling up of vast years of combined experience in the rules-based trading is not only fascinating, also extremely practical. All the hard work is greatly appreciated. So we appreciate you, James, for mentioning that. Naturally, I have some questions. You infer that you're not a huge fan of the below system, and wonder if you could share some of your preferred system. And the below system was, okay. I think he's referring back to the original turtle system, the 40 in, 20 out, so to speak. So, of course, you've changed. We don't apply it that way. So maybe I think that's what he's referring, saying, well, we're not a huge fan. Well, we're a fan of the principles, but we may not apply the exact same rules and time frames. So in that sense, you are correct, James. So one thing James is asking is just if you can share some of your preferred systems. Of course, we can do that. And then he has some questions here. I wanted to get your perspective views, or respective views, I should say, on the point at which you enter the trade. Do you find it's better, safer to execute intraday as you cross through highs or lows or whatever system signal you have triggered? Wait for a close over the high and trade the following open? Or do you wait a little later for a pullback or regeneration post the initial break? Would you consider a combination of these, i.e. a waiting to each of these to be a best methodology as well? So I think, first question is, we've obviously adopted the original, or you have adopted the original turtle rules or adopted from them. We do something different on our side, which I can talk about. And then the other thing is about execution of a trade. Do we take the signal as and when it happens? Do we wait a day? Until we get it confirmed? Do we do a combination of that? Let's start with that. There's one more question actually, Jerry, from James, but let's start with that. Thoughts, comments?
Let's say, obviously I think the core concepts that I was taught, it's almost impossible to improve upon them. I've not been able to improve materially upon the money management and the strategy and the philosophy, pretty little of which is in the public domain, the philosophy and how to evolve, but certainly the time frame, I was not able to, I had to expand the time frame, the look back period on a pure trend following systematic approach. And so I have I hold trades for a year or two now versus days or weeks or months, weeks and months, let's say, like some people still do, or like I used to in the 80s. So that is, we've said many times, but diversified, long-term, play for 1 or 2 year trends, longs and shorts, trade everything the same way. All of these ideas we've mentioned a million times. And so I don't know if the second question was the question about buying the
execution.
Highs. Execution.
Yeah. Well, whether you take the trade right when it happens, do you wait until it's confirmed as a close above the break, or do you wait for a pullback, or a combination of those? That was the question, I think, Jerry.
Yeah, I mean, I think all of those ideas were mentioned, were discussed in 1983. They're all kind of like
wow.
They're all kind of like bad ideas to some degree. Yes, you follow the system. Yes, you take the breakout. No, you don't wait for a pullback. That's not part of the system. Try to buy the high of the day. Be a trend follower every minute, hour, day, week, month of the year. Always buy higher prices. It's a loser's game to sort of nuance that and not follow the system and try to buy a break or, do something outside of, just being a pure trend and thinking that higher prices are better. I'm waiting for that 50-day breakout or 100-day breakout. I can't wait. I'm going to buy. I'm so psyched by this. This is how I trade. Oh, but wait a second. When it happens, I'll nuance it. I'll have to wait for a little break in the market or, what? What are you thinking? Why? Get that out of your head. It's just, it's your non-systematic worldview, your bad human bias coming through.
Yeah, I mean, so I agree with Jerry on obviously he's the expert on whether the original turtle rules needs to be changed or not. But as you can hear James, that it's really mainly the time frame that has changed on his side. So I can't really add much to that side of things. I do believe that looking at how we do things on our side, that there are many ways of doing trend following. So you have your traditional breakout systems. You have other ways of applying trend following, whether it be moving average crossover, whether it be time series momentum strategies. So there are obviously more ways than just the original turtle way to do things, and I think they all have benefits, and there are pros and cons with all of them. And we use two of them: breakout and time series momentum, so to speak, but in our own way. So in that sense, that's how we've evolved, coming from pure breakout. That's where we started in the 70s, but since '06, we've certainly evolved the strategy, and since '09, we've had more than just breakout methodology in our trend following model. So that's one thing. In terms of the execution of trades, I mean, again, Jerry does it one way. We do it slightly different because we wait for the day to be over to run all our models. They're end of day type of things. So we calculate based on those on that data what our new position should be, and then we basically just go and execute once the market's open again, pretty much. We could also trade, we could do it early in the day and get it done the same day. I don't think for a long-term trend follower, whether you trade on the day or the next day, I actually don't think that's where your edge is. I don't think that's where the big difference in performance will come. So I think either way is fine personally. But make it simple. Make it as simple as possible for you. If you use stops, why not just trade the stop when it gets hit? There's nothing wrong with that.
I agree. I think buying on the close, buying on the open, buying during the day, it's all fine. And I 100% agree that there's no edge. You're long term. How could there be an edge?
Yeah.
But that is true of waiting for a pullback. There's no edge.
That's different, right? That's different.
That's different. There's no edge there as well.
Right.
I don't know that.
And you shouldn't get into that. I mean, I think this is where it goes completely off rail from trend following. If you start sitting and waiting for things to happen after you get your signal. If you get your signal, you get in or you get out. That's it. End of chapter. But
exactly.
Don't add anything to that. Last question from James is: what do you find is your average leverage in the portfolio, and how many positions would you have on at any one time? With so much diversification by asset class and process, one would assume you always have a lot of trades on. Well, I'm happy to go first on this one. So James, we trade 53, 54 different futures markets from a trend following perspective. And I would say usually we have positions on in all of them, but because we don't really have because we have multiple systems, it would be very rare we would have absolutely zero contracts on. But our positions can be so small that you could probably say we're pretty much flat in a market, so that's different. So that's how we do it. Leverage is something that I think is a hard concept to quantify because it means slightly different things to different people, especially if you trade some of the futures markets that we trade where notional contract value can be big, but if you know where you're getting out, your risk is obviously contained to some degree. So, but yeah, I mean, leverage can be in notional terms quite sizable. 5-10 times is not unheard of in our industry for sure. Maybe another way better to look at it if you're a diversified trader is just to look at your margin to equity ratio, because we trade more or less the same market. So if you think of people who may run, say, a 10% margin to equity ratio, I would call them kind of lower risk-ish. Certainly our institutional version of our program runs in that area, 10 to 12%, while our original fully leveraged high octane trend following strategy, it's twice that. But it doesn't mean you can't get even further up the curve in terms of margin to equity ratio when you're fully invested. But it's usually also where you're doing well because there are lots of trends, lots of opportunities. So as long as you have a good risk process, good way of managing your risk, good way of making sure you get out once things get a little bit tough. Don't be too afraid and bogged down with whether it's one number or another, but make sure you have good risk management tools. I actually think risk management, funnily enough, I think it's a hugely important part of what we do. And talk about edge, I think you can have some edge with good risk management.
I agree with how it's difficult to explain. I looked at our portfolio, and it's of the maximum positions we can have on risk-wise, we were at 70%, equally long and short, which would reduce risk. That's always helpful. The longs are sort of correlated. The shorts are kind of correlated, regardless of the sector, let's say. So, and in the longer term you trade, you're going to have, more of your positions on, max positions on. And that may sound like, well, gosh, that's a real negative for longer term. And I'm going to be in the markets and have positions on, bigger positions on, just by that one fact. But it is, but the problem is that the shorter term you trade, you're setting yourself up to having to get back in the market that you just got out of, obviously. So that's to be avoided as well. I think, you want to find that sweet spot where it's not too long term, but it's not too short term either. And then the way I would look at the risk and the leverage would be strictly, and I'm going to choose my words very carefully. So there's not going to be any reason for any follow-up. Just keep listening to how I would describe this. And that is that I look at it in terms of how much are you risking when the market has an average move, on a daily basis. Let's say it moves a certain, if gold moves $10 on average these days, how much, if I have a long position or a short position, how much am I going to, how much is that going to impact my portfolio? So I think, something like 10 basis points, 5 basis points, somewhere in between there per market. I've got on a lot of trades, a lot of markets, over 75, 80 markets. And I have positions in 75% of them, of my max position. I might be in all the markets like Neil said, but some of the positions are small. Some of my systems are long. Some of my systems can be short in the same market, let's say. But that's how I would look at it is, sort of normal things happen in each market. How much should I expect the market to move, my portfolio to make or lose? And a lot of these positions, they're very, they'll be X'd out because, there's a lot of diversification there. So there'll be extreme periods where usually you make 50 basis points or lose 50 basis points a day. There can be times where you lose 3% in a day because of volatility and correlations. But I think looking at things on sort of a normal average day, what should I expect my profit and loss to be? I think that's where the rubber meets the road.
I couldn't agree more. I think that's really important, actually. That's great advice from you, Jerry. And I think people need to track this. I know we pay a lot of attention to that, our expected volatility on a daily basis. We track very carefully our outliers, so we know exactly how many to expect on a yearly basis as well. All of these things are important. So I'm glad you brought that up. James, I hope that was some of the answers you were looking for. While you think, Jerry, of anything else that you want to bring up, then I will just run through the performance as of Thursday. So I think Friday was a positive day, slight at least, for most trend followers. But these numbers are as of Thursday. So up 247 for the month of the Beta 50 index, up 7.9% for the year. SocGen CT index up 2.63 for the month, up 7.54 for the year. The SocGen Trend Index up 3.62 for the month, up 11.32% for the year. And the Short-Term Traders Index up 41 basis points for the month, up 66 basis points for the year. And the Bridge Alternatives Index up 2.28% for the month and up 7.83% for the year. So still solid across the board for at least trend followers, medium to longer term trend followers. Since Moritz is out, we still have a free slate. Jerry, we can talk about anything we want without restrictions. I'm just teasing Moritz here. Anything else you want to bring up that you think would be useful to set the week? A week where we're going to have a US rate decision. Lots of anticipation in the markets.
Yeah, I would just shout out to our friend and podcast guest a few weeks ago, Salem Abraham, is going to shut down his 30-year track record of trading futures, trend following, and go into more of a traditional business of, I guess he described it as what some of the endowments do: long stocks, permanent long stocks, long bonds with 6 to 10 hedge funds on the side are added. So I wish them luck on that, and we'll miss them. And frankly, or honestly, hopefully it'll be a good sign for us that as more of our brethren retire or get frustrated and call it quits on our lifelong pursuit of trend following, that it'll mean something good for the rest of us who remain, or maybe we'll be joining them. Who knows? But we're undeterred at this moment.
Absolutely. We, of course, wish Salem the best with his new venture. And as you said, it's always sad to see, a fellow peer who's been around for a long time, done really well for his investors, decide not to pursue trend following anymore. But that is the business we're in. I think on that note, let's wrap up our conversation this week, Jerry. We hope that all of you enjoyed it. Let me just say, if you want to support the podcast, you can. Not financially, but if you just head over to toptradersunplugged.com/review and leave us a nice comment and rating, you will actually be helping us much more than you think. So we would appreciate that. For those of you interested in the live event, now you can just hit toptradersunplugged.com/live and you'll see all the information you need to reserve one of the few spots that are left for this New York event. And all that's left for me to say is that from Jerry and me, thanks so much for listening. We look forward to being back with you on next week's edition of The Systematic Investor. And in the meantime, have a wonderful week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of this.